Hi everyone, welcome to today's video. In this episode, we'll talk about how to algorithmically identify different market regimes, one of the most important skills for building adaptive trading systems that can survive in any condition. Let's get started. A market regime describes the current state or mood of the market, basically how the market behaves over time. When it comes to stock indices, we usually talk about four main regimes: a bullish trend, when prices steadily rise, a bearish trend when they decline, a sideways or range-bound market when prices move without direction, and a high volatility regime when markets react sharply to news or uncertainty. Identifying which regime we're in helps algorithms choose the right strategy, whether to follow the trend, trade the range, or stay out of the market entirely. I have generated a new set of strategies using our Keltner break template in long-only mode on the Nasdaq index based on a 5-minute time frame. From all the candidates, I selected 60 strategies. These systems are designed to break out of relatively narrow volatility channels and use a trailing stop loss to capture smaller profits. By nature, these strategies perform best in low volatility bullish environments when the market trends gently upward. From these selected systems, I have built a complete portfolio for further testing and analysis. I combine all strategies from the portfolio into one single equity curve. This means I average the entire functional range of the volatility channel used for generating entries. I do not focus on just one isolated strategy taken out of context. Instead, I observe the overall performance of the entire portfolio. Then, I activate a benchmark to compare the portfolio results with the main index. Even though my strategies trade the Nasdaq and the benchmark is the S&P 500, the market regimes are still clearly visible when compared side by side. I can clearly see the periods when the index was rising or falling, and this behavior corresponds well with my portfolio equity curve. However, the best way to evaluate performance is through statistics on unseen data. So I used a true out-of-sample dataset from this year, and here the market regimes are clearly visible. You can immediately recognize when the market shifts from bullish to sideways or bearish conditions. Looking at this year, in the first part the index is falling, then it suddenly starts to rise sharply. Even though these are long moves, the volatility is very high, and my strategies are designed for lower volatility conditions. In the second half of the year, volatility decreases and we can see smoother upward movements. These long phases are ideal for this type of strategy and bring much better performance. I created a simple, long-only strategy that breaks a specific standard deviation level. When a trade is opened, it uses only a stop loss and a take profit. This strategy is designed for periods of high volatility in the long direction. I ran an optimization around plus or minus 30% from the ideal parameter values and then combined all equity curves into one portfolio. This allows me to see how the strategy performs across the entire average functional range, not just at one precise parameter setting. I can see that in the part of the chart with the strongest long volatility, the strategy performed the best. You can think of the outcome of this video as a way to classify strategies based on different market regimes. Then, according to the current regime, you can adjust the portfolio weights of each strategy to better fit market conditions. Thank you for watching, and I look forward to seeing you in the next video.